From the Lineweaver Wealth Watch Center, this is the Financial Quarterback.
I'm Jim Lineweaver, your financial quarterback since 1993. We know you try to be as informed as possible when making financial decisions, but all too often we hear from people making mistakes that could have been avoided if they had just consulted with a financial advisor. And these mistakes have compounding effect. Today I'm joined by Mark Sipos, the LFG Tax Director, to talk about a situation our clients got themselves into and how we helped them avoid some costly mistakes.
Thanks, Jim. We had a recent case that came in, and our client wanted to put an addition on her house. She wanted to use IRA money to pay for the full amount, which could have been very costly from a tax point, and also her Medicare premiums would have shot up.
Yeah, and she needed about $150,000 before taxes, and taking that directly out of her IRA as she had planned would have increased her tax bracket quite a bit, increased taxes on her Social Security, and increased her Medicare premiums. As a matter of fact, the Medicare premiums alone would have increased over $5,000 a year.
And we developed a plan where we took about a third of her IRA, which kept her in the same tax bracket, and also kept her Medicare premiums at the same rate. We then helped her secure a HELOC, or a home equity loan, and used portfolio income to help pay for that over time.
Yeah, and I'm saving her a lot of money. So let's take another example. We had another client who had a 401k with a significant amount of their employer stock in it, and they wanted to roll this over to an IRA. But the stock had appreciated significantly, which meant they'd owe a lot of taxes if they had rolled it over and then started making withdrawals.
And we suggested a strategy called net unrealized appreciation, which helps save the client quite a bit. It's also known as NUA.
Yeah, and usually when people look to retire, they roll 100% of their 401k to an IRA, and everything you paid for that company stock inside the 401k and all the appreciation through the years will be taxed at your personal income rate when you take money out to supplement your retirement. But instead, if you use the NUA rules, you can roll the stock out of the 401k, pay ordinary income taxes only on the cost basis and what you paid for the stock through the years. Then, if done correctly, you can have the appreciation of the stock taxed at the much lower capital gain rates. And for most people, this could cut their tax bill almost in half.
And it's really two parts, like you mentioned. The cost basis, which was the original cost put into the plan, which is taxed as ordinary income, and then all the appreciated could also be taxed at long-term capital gain rates. But the rules are tricky, and you really need to get the proper advice.
Yeah, so let's run through a quick example. So let's say you had $300,000 of company stock in your 401k. Now you only paid $100,000 for it. You roll the stock out of the 401k to a non-IRA account. You pay taxes on the first $100,000 at your ordinary income rate, but the additional $200,000 would be taxed at a capital gain rate if done correctly.
And with the highest tax rate of ordinary income of 37%, long-term capital gains are capped at 20%. That could have saved them $34,000 or more.
So we hope these experiences from our clients give you insight as to why it's so important for you to be able to talk to a team of financial professionals before making any big decisions. So reach out to our team before you potentially make any costly mistakes. We're always here to help.